So we can discuss about primary and secondary market. So it's a continuation of the financial markets capital market which we saw in the earlier lecture. So financial market, it is considered to be a part of the capital market, and this is an important market which actually plays a role in raising capital or financial support for organizations, as well as it is also used by governments to manage inflation and other things. So in a nutshell, indirectly it is going to affect the household savings of the economy also. So there are various types of capital market, and we consider the primary market, the secondary market, and then we have a third category of market which is called the derivatives market. So as I told you in the first lecture, the primary market is the place where the stocks or securities are traded for the first time. So whenever the company is going to issue shares to the public for the first time, then it is considered to be a primary market. And after it goes to the public, and if they want to sell it, then they go to the secondary market and place a trade over there. So there is a clear difference between a primary and secondary market. So whenever any trade happens in a primary market, the money is going to the company, and whenever a trade happens in the secondary market, the money is going to the holder of those instruments. So it could be individuals like you and me who have invested for the first time in those instruments. So this is a part of the secondary market. And then you have derivatives market. So here again, right now you find that these instruments are traded in the secondary market. You call it as financially engineered products. The derivatives market is otherwise considered to be financially engineered products. You have the futures market, you have the options market, you have the swaps which is there, credit swaps and other things which is there. So this is all part of the derivatives market, and now they have tried to integrate it with the secondary market which is prevailing in most of the economies. Apart from this, you can have different set of derivative market which is called the commodity market. So in India you have the multi-commodity exchange, you have NCDEX, all these things are part of the commodity markets. So if we are going to classify capital market, you can classify it basically broadly into two categories. One is called a primary market, the second one is called the secondary market. Primary market deals with, as I told you, newly issued equities or newly issued bonds. And when I am talking about secondary market, it talks about the old issued bonds and old issued equities. So this is how it is happening over there. So let us go to the primary market in detail and understand what it is. So whenever I am talking about primary market, a common thing which comes to our mind is IPO. So IPO is nothing but initial public offering. As the name suggests, it is initial. Initial means the first issue. The first issue is considered to be initial. So public, so first time you are going to the public. So whenever the company is going to the public for the first time, then it is considered to be part of primary market. And whenever you want to go into the primary market, there are strict regulations which is there in place. Okay, and mostly you will find that the primary market is concerned with individuals who are part of small investors like you and me. I have 1000 rupees savings with me. I can go to the primary market, invest in stocks. But there is a problem with that over here, that sometimes the companies will keep a minimum number of stocks which has to be purchased. So it means to say that if suppose I am a company who is going to issue shares in the initial public offering or the IPO, I say that the value of one share is 10 rupees, and anyone who wants to purchase will have to purchase at least 100 shares. So, which means I have to invest at least rupees 1000. So, I cannot buy anything less than 100 shares. So, I can have a restriction in terms of the investment in a primary market, but normally it is considered to be meant for small investors, and anyone can participate, even big investors participate in the market. Let us talk about primary market in detail. So, in detail, when we are going into the primary market, I told you it talks about the market which is in the primary place or the first time market. So, how can I enter into the market which is for the first time? So, first one is public issue through prospectus. So, what do you mean by this? First, let us understand that what prospectus is. So, whenever I want to take admission in any college or university, I would like to get the prospectus from them. So, what information does a prospectus have? It has information about the teachers, what type of teachers the college has, what is the teacher-student ratio, what is the lab facility which is available, what are the other welfare facilities for the students which is available. So, like that, all the information about the colleges are received from the prospectus. Similarly, when a company goes to the public for the first time, they prepare a prospectus, and this prospectus has information with regard to the risk factors which is likely to affect the company, the various regulations which the government has in place, which has to be followed by these companies. It could be like the National Green Tribunal, like that, any of those regulatory framework, if it is there, then it would be put up in the prospectus. It talks about what the total capital of a company would be, what would be the capital spending, who would be the target audience or the customers of these products, and how they would be going into the whole process from manufacturing to sales, and all those various aspects which is required to be known by the investor would be put up in this prospectus. So, before I go into detail, I would like to make you go through the earlier things which you might have already seen. There are two major documents which has to be submitted by a company whenever they go into the incorporation. One is called the Memorandum of Association, and the other one is called the Articles of Association. Memorandum of Association talks about the structure of the organization, and the Articles of Association talks about the policy aspects of the organization. So, let us focus upon the Memorandum of Association. In the Memorandum of Association, the various aspects are mentioned in different clauses. Okay, and one of the clause within the Memorandum of Association is the share clause. Okay, the share clause says that what is the authorized capital which the company can raise, how much capital the company can raise, and how it can be raised. All these things are mentioned in the in this particular clause. So, this amount which is going to the public should be within the limit which is mentioned in the authorized capital. Say for example, if suppose the company requires 1 lakh rupees for functioning at full capacity, and this 1 lakh rupees is divided into small units of 10 rupees each, it means to say that we have 10,000 shares of 10 rupees which is equal to 1 lakh rupees. So, I can either go to the public in one go by saying that you can ask 10,000 shares to be purchased at 10 rupees, or I can go in parts where I say that right now I require only 20,000 rupees. So, which means I am going to issue only 2,000 shares of 10 rupees each, which is to be published. Okay. So, now when I am going to issue this through prospectus, what is happening is I prepare this prospectus And along with this memorandum and articles of association, this would be submitted to the registrar of companies. It would be submitted to the regulatory authority, which is SEBI, and it would be submitted to the nearest stock exchange which is closest to your registered office. So, which means if suppose I want to start a company in Varanasi, the nearest stock exchange which is available over here is Kanpur. Okay. So, as per rule, it says that at least I have to get it registered in Kanpur, and other than this I can select where I want it to be placed at the national level. So, I can also say that I want to go to NSE as well as BSE or any of these two. So, these documents has to be submitted to all these parties would be involved in it. So, they go through the prospectus, and once they are confirmed that it is fine, it can go to the public, then that is called the final prospectus. So, this prospectus which I have given over here for the first time is called the draft prospectus, and this draft prospectus, once it is reviewed, it is converted into the final prospectus. And this final prospectus, as per rule, it says that it has to be published in at least one national daily. It has to be published in at least one national daily and one local daily. So, it means to say that one newspaper which is at a national level, one at a local level, I have to publish it, and I say that whoever is interested can invest in my share based on the prospectus which is available, which is given to you. So, this is one way. I am not going much into the detail of these processes. We will take it up as we proceed. So, this is a part of the first one, which we call as public issue through prospectus. The second one is the offer for sale. Offer for sale, whenever I require money, going to the public is a costly affair, because all these places wherever I have submitted these prospectus, got it corrected, and finally when I go, I have to give some charges to all these parties. So, instead of doing that, I say I identify certain big financial institutions to whom I can give these shares, and these are given to them, and they are free to sell it in the open market. So, it means to say that I can identify an underwriter, and this underwriters would sell it in the open market. They would sell it in the open market. So, these underwriters are nothing but financial institutions or any organization which is having enough money to purchase shares in bulk from me, and it would be sold to the public at large. That is offer for sale. The next one is called the placement method. So, placement method is different from offer for sale in relation to the aspect that here you have a lock-in period. So, lock-in period, I say that you cannot sell the share to anyone else before 2 years, before 5 years, like that I keep a condition, then it becomes placement method. The other aspects which is related with offer for sale is same. I am going to give it to one organization or two different organizations or multiple organizations who are financially sound. Okay? And the first case, they can sell it immediately in the open market. The second case, they can sell it in the open market only after they go through the lock-in period. A third type of issue is called the rights issue. So, rights issue, as the name suggests, it is issued to those person who have a right to purchase. Who has the first right to purchase any shares? It is the shareholders, existing shareholders of the company. So, whenever I require money, I go to the existing shareholders of the company. I say that I want money. If you are interested, you can purchase it in accordance with the number of shares you already hold. So, I mean to say that if you are holding 10 shares, you can purchase 1 share from me. Okay. So, that is called a rights issue. So, you have the right, and if you are not going to execute the right, then it goes to the next person, or it can go to the open market. So I'm giving the right to the existing shareholders. Okay, that's called a rights issue. Next one is book building process. So book building process, of late you might have seen this book building process in combination with the first one, issue through prospectus. Okay, so in book building process, what is happening is that you do not have number of shares is not fixed. Either the shares is not fixed or the price is not fixed. Okay, so how does what does this mean? It means to say that if I want 10 shares to be issued to the public, or I want 100 rupees to be collected from the public, I say that I have shares, you can purchase, the face value of the share is 10 rupees, but similar companies has their share value in the open market at 100 rupees. So if you want, you can purchase it at 100 rupees. So if you find any individual who is ready to purchase it at 100 rupees, I fix the price as 100 rupees, then it means to say that the price is not fixed before the actual sale. I only identify a range. Okay, the price could be between 100 to 125. So it is a bidding process. Whoever wants to purchase my share can bid it between 100 and 125, and the number of shares can also be decided by the public, whoever is intending to invest. So such type of issue of share is called a book building process, where you do not fix the number of shares or you do not fix the price. You only say the range which is there. Okay, so then it is considered to be a book building process. Another way of raising money is through disinvestment. Of late, you might have seen most of the government organizations or public sector organizations are going in for disinvestment process. So disinvestment process, the shares are currently held by the government. It is going to the open market, and in the open market, anyone can purchase it at some price which is identified based on the market condition, based on the valuation which has been done. So this is called a disinvestment process. The next type is the employee stock option. So employee stock option, as the name suggests, it is an option which is given to the employee. So whenever I get an employment, whenever I get placed in a particular organization, the company says that the company gives me an option to purchase their own shares. So the idea behind this is that you become loyal to that organization. Let us assume that I got a job in Britannia company, okay, and Britannia company says that along with my employment, they are going to give me 100 shares. So this is a option which the company has given for being an employee of that particular organization. So it is a employee stock option. So what happens is, here anyone who is part of that organization becomes a shareholder of that organization, and if the company makes a profit, the part of the profit will come to me also, because I am a part of the organization by holding the shares of that particular company. So that's why it's called an employee stock option. The next way of raising fund is through preferential issue. So preferential issue, here the issue is being provided to the promoters of the company. I say that whenever I require money, the first person to whom I can go is my parents. Here the parents of the company is the promoters. So I issue shares to these promoters, then I give preference to those individuals who were part of my organization at the time of its formation. The next type of raising money is through venture capital. So venture capital for risky businesses, if you want fund, probably common individual may not be ready to take that much risk. So financial institutions have a separate wing. Of late, you find that most of the banks have these venture capital funds which is allocated, and they try to invest in startups or organization which is dealing with riskier projects, which is not proved in the market so far. So such type of raising money is called venture capital. The next type is private equity. So in Indian condition, if you are going to look at the 9th and 10th, that is venture capital and private equity, it is taken up interchangeably. But the difference between these two is that venture capital is provided in the first instance. After the company stabilizes, then if the venture capital organization want to exit the firm, then these shares can be purchased by the private equity firms. So there is a difference between these two firms which are involved. One which is ready to take risk at an initial stage of the organization is venture capital organizations. They have stayed with them for some time, and after the market stabilizes, where they can go in for mass commercialization, then they can sell their stake, and these stakes are purchased by the private equity organizations. So this is all about how a primary market functions. I told you how it is there. This offering is being provided by the companies. Okay, the companies are the nothing but the offerings. They are the persons who offer the number of shares which is required. And how do they get the whole process go into the market? Okay, so you have something called an underwriter. So underwriters take the job of these companies to take their shares to the public, okay, as well as they give guarantee. What guarantee does these underwriters give? In India, the rule says that if suppose 90% of the shares are not subscribed by the public, then it has to be refunded back, and after that we would be going in for the issue once again. Okay. So this I told you earlier that it's a costly affair. So what does the company do? The company identifies some financial institutions who can give them a guarantee that if suppose 90% is not subscribed by the public, then they are ready to take those remaining 10%, so that they need not repay the whole things. So they act as a guarantor for the issuing organization, and they take part in the whole process, and it goes to the distribution where it goes to the public. Okay. And this underwriters also have a role to play in price stabilization of share. Okay. So what does price stabilization mean? Price stabilization means whenever shares are issued for the first time in the market, the first hour of issue, you will find that there is lot of fluctuation in the market. Okay. So in order to reduce this fluctuation, let us assume the price is going up very much. So these underwriters, when the price increases, they would be purchasing shares from the market. Okay. So when they purchase, automatically the price will come down. So they are stabilizing the market. Whenever there is a decrease, they issue shares in the market. Okay. So how do they issue shares in the market? Whenever they issue, what happens? The prices are likely to come down again, and it stabilizes, go up, and it stabilizes. So how does they actually participate? There's something called a green shoe option. So green shoe option means the option given to underwriters to stabilize by using excess number of shares and stabilize the market price. Okay. So when the prices go up, they are, what they are doing, the demand is more and the supply is less. So what they do? They issue more shares in the market. I told the reverse way earlier, kindly correct it. So it is issuing shares whenever the price goes up, and automatically the price would come down. And here the price is decreased, so they purchase the shares and the prices come down. So this is a part of the green shoe option, where the excess number of shares which these underwriters would have to give it in the market is provided to them by the company at the earlier stage itself, and this was bought into the market for the first time by a company called Green Shoe. That is why it is known by their name as Green Shoe option. Now let us go to the secondary market. Secondary market, I told you, after all these money come to the company, so different ways we have already discussed, come to the market from the individual investors, they go to the secondary market, and secondary market is a platform where the shares of the company are traded. So the examples of secondary market is BSE and NSE, as you have. Okay, and who are participants in the secondary market? The participants in the secondary market are the retail investors, and apart from that you have various other parties who are part of the secondary market, which we will take it up when we discuss the participants in financial market. Okay, and you also have the financial intermediaries like NBFCs and others also participating in the whole process. You have two different types of secondary market. One is the stock exchange, which I have already told you that it is a platform where I can purchase and sell the shares which I am having. Okay, you have various rules which is framed by the regulatory authorities for trading, and in terms of derivatives, sometimes the stock exchange also acts as guarantor. So the margin money would be provided. So I will go into it when we discuss about SEBI and other things, and counterparty risk is also taken care of. So here the stock exchanges say how much margin money has to be maintained in your account so that you can trade, and whatever is being traded is in the safe custody of the stock exchanges, and they charge certain transaction costs. So as and when the transaction cost goes up, it means to say that it becomes a safe transaction. Okay, and I think I've already discussed all these aspects where it talks about liquidity, secondary market. Whenever I wish to raise money, convert my shares into cash, I can go to the secondary market, and the individual investor cannot directly go and issue it, and any investors can participate in it. The second type of secondary market is the over-the-counter market. So this is normally seen in forex and for commodities. Okay, so here you do not have a formalized market available. So the market which is available is between two individuals. I am a person who hold tomatoes with me, and you want to purchase it. So I sit and discuss with you. It's a negotiation which happens, and I say I am ready to sell it to you at this particular price. And this OTC market provides me this platform to identify who is ready to purchase it from me. So it is a platform where buyers and sellers come, sit together, discuss, identify the price at which it has to be done. So such type of market is called a over-the-counter market. So the major difference between primary and secondary market, as you might have understood, primary market, it issues for the first time. Secondary market deals with those which is already issued. Okay, so the same thing is told over here. It is new issue market and secondary thing. Type of product, it could be the initial public offer or follow-on public offers, and what is available in the stock market could be either shares, warrants, debt instruments, derivatives, all those things. Purchase type, this is directly from the company, this is from the investors. Frequency of selling, primary market, the company goes to the public only once, whereas this can be as and when required. Who are the parties involved? The companies and the investors. Here the investors and the buyers and the sellers. Okay, so it's derived from, the price is derived from the share value or the face value which is prevalent, whereas this In the secondary market, it is determined based on demand and supply. Regulatory, both regulated by SEBI and other things as far as India is concerned. So in this, we have gone through informations which is provided in the various suggested readings which is provided, and I have tried to give you an outline of what a primary market is and a secondary market is. Thank you.